There are many factors to consider when looking at the current environment. We see the stock market, which is sitting at the same level since January of 2018. We have the economy pointing downward. We have upheaval in all parts of the world, and absurdly having the media reporting that everything is just fine. Perhaps I'm dreaming and everything is awesome? You came here for the truth, so let me unveil that for you. Today we're going to look at what's happening with the yield curve and show you what's going on in the markets. We are going to talk about several statistics that are underreported in the mainstream media. And why? Because it's not fun, because it's not interesting, because it's not quote unquote positive. But I don't know about you, I prefer the truth. The markets are doing fantastic on Tuesday's trading session. Here you could see the Dow Jones up 400 points. Wow, everything is fixed. Everything is resolved. Look at the VIX index. It is at 18, so you know that everything is fine. You don't have to worry about the Federal Reserve admitting to the fact that they have a short position on volatility. Well, of course, let's see why. Well, the US is apparently delaying China tariffs for some items, including cell phones, and removing other products from the list. Apparently, the reason for this is that the Christmas shopping season is coming up, and of course, maybe, but probably not, this is what we're being told, maybe, but probably not, this could impact some consumers. Don't worry about it, it's not going to affect them, but we're just going to remove these from the tariffs, and others will be delayed. December 15th is the day for that. On the news, Best Buy, Apple, others, they really rose very high as a result. Initially, they had come down quite a bit because of the suggestion that they were going to go towards this. And unbelievably, they included national security as one of the reasons why they're delaying some of these tariffs. Oh, I love it so much. They can use that for just about anything. And still today, nearly 2 decades after they were really starting to use that term all the time, it is conveniently put here today. I love that so much. Bond market close to sending the biggest recession signal yet. We are looking at the 10-year and the 2-year. This is considered to be the holy grail. This is what everybody is looking at. Even though all of the other ones have already inverted, this happens to be the most closely watched indicator of them all. I thought this was funny, the quote at the bottom here. It's the whole idea that the Fed is making a mistake. So immediately I stopped and thought, what mistake are they making here? That they're decreasing interest rates? Because that's what they're doing right now, and the market loves that. There's more fear that the Fed is going to be slow in making moves and the economy is going to go into recession. So basically, you're not decreasing interest rates fast enough. The fact that you are engaging in the most massive monetary easing experiment ever in history, it's not enough. No. Your quantitative tightening policy that you actually stopped way before it was ever supposed to, that's not enough. You need to go interest rate crazy right now. You need to bring them down to zero as fast as you possibly can, or you are quote unquote making a mistake. I don't know about you, but I think it's the other way around. I think what they're doing is making a mistake. By the time you're watching this video, it may have already happened, but the main yield curve nearly inverts as the 10-year yield tops the 2-year rate by just 1 basis point. All right, so as I said, this may actually be the case by the time you watch this video. It looks like it's going to invert. The rest of them did. Now, whether it stays down below, we'll see if that's the case. It looks like for the other ones, at least they have, so it will probably follow suit. Now, why is this the case? Where is all the strength? Where is all of these supposedly strong indications of a healthy economy and so on? I'm not seeing it, okay? If you look at the stock market itself, the All Country World Index is below where it was in January 2018. If you look at, for example, the S&P 500, the Dow Jones, they're basically at the same level they were January 2018. We've got a problem here because that is a year and a half ago, and with all the stimulation, with the negative interest rates that are going on in so many countries, with the extremely low interest rates in every other country, we should have a perpetual boom forever and ever based on what they say. But that isn't the case. So we know that something is definitely screwed up. Bonds haven't been this popular since the financial crisis as recession fears rise. When people get scared, they look for safe havens. There are different levels of safe havens, of course. At the absolute last, when people are panicking and it's way too late, then they start looking at gold. But they start to look at bonds and they start to readjust their portfolio in the meantime. Because when things are good, when we are talking about early in the cycle, we start to see that people are shifting their money around. They're trying to be a little bit more cautious with their investments, and we see that occurring right now. Fund managers surveyed by Bank of America are the most bullish on bonds since November 2008, even though they think that the trade is overcrowded. This is part of the fund manager survey that I show you regularly. And essentially what we have right now is this data that is correlated to all of that, which I've been showing you recently. Money's flowing into bonds, money is leaving equities. This article here is talking about the 10-year, the 2-year. In the second paragraph, it just says traders were also watching the 30-year bond yield, which neared an all-time low. The value of money is really declining. You can see that here right now. Around the world, we have $15 trillion in negative yielding bonds. What does that tell you? There is nowhere that you can find some sort of asset that is quote-unquote risk-free that will actually provide you a return. So people are taking more risk. They're going further and further out into the wilderness to be able to try and get a little bit of yield. Today we've got a big problem, and I do believe that it will be exposed in time. The majority of people have seen this buy the dip strategy, how it has worked up until 2017. In 2018, it didn't work at all. In 2019, things have been really crazy. If you look at what has occurred 2019, yes, if you take it from January 1st up until the present, absolutely, stock market's up. But are you not including the fourth quarter of 2018? It's a little bit ridiculous to take it from January 1st, year to date, when you know what happened before that. A 20% drop, of course, everything came up after that. You have a problem though, because the markets are hoping and praying and actually demanding that the Federal Reserve react and in fact overreact to the information that is being provided today. Take a look at the US Treasury yields. Come on, over the last several months, these have all fallen quite dramatically. That is not a good sign, as you see all of the money rushing towards these bonds. Money has been leaving the United States equities, particularly from foreigners. The EPFR has all of that data tracked, and you should absolutely be paying attention. U.S. consumer prices rose at a robust pace in July on the back of higher prices for energy and most other goods and services, a possible sign that inflation is finding its footing after a weak start to the year. Remember what Jerome Powell was saying? This was only going to be temporary, inflation would pick up. They still brought interest rates down. They still actually went ahead of themselves in this quote-unquote mid-cycle adjustment, but here now we can see, even with their fake manipulation way of calculating inflation, it rose, okay? So does that mean that we're not going to get another rate cut in September? Well, you tell me. The Consumer Price Index, which measures what Americans pay for goods and services ranging from mutton chops to motel rooms, rose a seasonally adjusted 0.3% last month from June and 1.8% from July 2018. We are getting closer and closer to the 2% mark, which is what they always love to see. Now, you can measure this based on the CPI. You can look at the core PCE. You can look at the trimmed mean PCE, and a whole other list of letters in the alphabet. It doesn't matter. All of these are manipulated, and they could be showing one thing or another, whatever they want. In this case today, we could see even in their world, prices have risen. That should be an indicator that interest rates should not drop. If you're trying to achieve that 2% rating, you don't have to worry based on this data. Inflation is picking up. But I do believe that they know exactly what's going on, that they're not looking at this absolutely garbage way of calculating inflation. They are trying to create a bubble that is bigger than anything we have ever seen before. Here you can see the core CPI since the year 2000. Of course, this fluctuates, and right now it's showing us 2.2%. Global manufacturing PMI and new orders sub-index contracting for the second consecutive month. You could see this on the chart. The yellow line is new orders, the blue is headline, and of course you could see it moving down below the 50 mark. This is very important because it goes not just with this, but all of the others that I've shown you all around the world. They are all contracting at this time. That is a real economic statistic. The global CapEx cycle has ground to a halt, a sharp fall off in nominal capital goods import growth. Take a look at where it was, let's say a year ago up until today. This has dropped significantly. Again, despite all the stimulus, despite everything that has happened over the past few years, there has been no stopping what is happening today. Goldman Sachs bear market risk indicator. I've shown you this before. Here's an updated chart. So here's the breakdown. Average percentile for ISM, slope of yield curve, core inflation, unemployment, and the Shiller PE. For unemployment in the yield curve, a lower reading corresponds to a higher, riskier percentile. Look at what is occurring right now. I'm going to bring out my highlighter to show you this. It is an absolute fact in basically every instance. When you have this same thing occurring, you get this going higher and higher. The percentages here. So this line right here is basically the 70% mark. Right now it's showing us that we're at 71%. It's already on its way down, as you can see right here, okay? It's already on its way down, and in previous instances, when it makes its way down, that is the beginning of the recession, okay? It's not 100% perfect. There are instances in which this may not be the case initially, take some time, but in general, if you look at this, here you could see that it was a little slower back in the 90s to take effect, but ultimately you see the pattern, okay? So every time it is basically in this recession, and it will show you that documented here, no way to deny it. Now this could in fact turn around and we could have it going higher and higher, go to 200% if you want. It doesn't really matter to me. I'm just showing you the stats. I'm giving it to you. I hope you do appreciate that. Two more really quickly. Probability of recession at the 17-month horizon. Why 17 months? Not exactly sure, but Rabobank put this together. Higher than in 2007, higher than in the year 2000. The probability is going off the charts. In this case, it looks like 80% right now at this time. And why? We have a stock market that's done well. We have this economy that's apparently doing well. No, they know what's actually happening. They could see it being built up. Nobody is expecting a calamity, a catastrophe, but any institution who is willing to actually admit the truth is at least saying something is going to happen, some sort of credit cycle. And just to finish the video off here, I thought this was hilarious because they fixed their currency right here, as you can see, at 7.0326 per dollar. That's stronger than expected, okay? First of all, it's weaker than the 7 per dollar mark, okay? We know that already, but the expectation was 7.0421, okay? And so as a result, things look good. Now, this type of behavior that I see in the markets is absolutely ridiculous. There is no other way to put it. It's weaker than where it was going to be before, and already the market has forgotten about that. Slowly but surely, they can weaken it further and further and further, and then the markets, as long as they do it in a way that is expected, apparently nothing is wrong with that. Well, anyway, I'm going to end the video there. I had enough. If you found this informative, hit that thumbs up button. You are supporting this channel. Thank you very much. If you want the financial education you were not taught in school, these two books have everything you need, top to bottom, A to Z. All the details are located at the link in the description. If you want the audiobook, that's available at themoneygps.com. Have you seen what's going on in China right now? Definitely check out this video. I break it all down. Click on it and I will see you there.